Hello, welcome back to Fiscal Flows. Today we're going to be addressing the balance sheet. We're going to be looking into assets and liabilities. The company we're going to be using is Caterpillar, and we're going to use the platform AlphaSpread to do the analysis. This is going to be a part of a two-part series where the first part we're going to be looking into assets most of the time, and then the other one we're going to talk more about liabilities and equity. So first of all, what is assets? I will use it from a personal standpoint. Assets is basically what you own. For example, in your personal life, you can own a car, you can own a house, and so on. These are assets. And also you can own money, for example. You can have a friend that owes you something. That's also a form of assets. So it's basically the same as what a person owns, but just from a business perspective. An asset is always connected in some way to liabilities. For example, if you borrow money to buy a house, for example, you get a mortgage. Let's say you borrow 2 million. On the asset side, you will add 2 million, and then on the liability side, you will also add 2 million because you owe the bank 2 million, and then you also have 2 million in cash. And that's how these two basically are connected. And it's the same basically if you would have paid your loan, you pay back the 2 million, you would basically remove 2 million from your cash, basically what you own right here and now. And then also you would have to remove the 2 million that you own in debt on the liability side. So these two are connected. So let's get into the first one, assets. There are different type of assets. And as you can see here, you have something called current assets. Current assets is basically short-term assets. When you think about current assets, you should think about how long does these type of assets last, and also how fast you can convert them to cash. So usually short-term assets are basically things that you're going to have for about 1 year before you, for example, sell them. In this case, it will be, for example, machines that they make that they're planning to sell within a year. Those should be within current assets, and also same as cash, for example, basically things that you're going to have in a short term, or things that you have that you're going to plan to sell within a year, and things that you can easily convert to cash. So as you can see here, the first one is cash and short-term investments. The cash part is really simple. It's basically money that you have in the bank, in your bank account, or money that you have physical. And then you have short-term investment. That can be, for example, bonds. And as I said, the 1 year rule, and also the ones that you can convert easily to cash. Short-term bonds can be that. For example, 1 year bond. But 10-year bonds, for example, those ones are not as or they last longer. And if you're bounded to those, and they're not current assets because they're not short-term, they're meant for the long term. The other one you have is receivables. Receivables is basically what the customers or your customers owe you. So let's say, for example, you sell them or a machine. You sell them a machine for, let's say, $100,000, and then they don't pay that immediately. They get a invoice instead. And I know probably a lot of people have, or a lot of you watching this have had an invoice before, and you haven't really paid for the stuff that you got. So in that case, you basically owe the company. And as I said, receivables is basically just what the company is owed by their customers. So when they give out, let's say, for example, they sell a tool or a machine, for example, then, and let's say the machine costs $100,000, then this company would give you the machine, and then they would add $100,000 in receivables. So you'd say plus $100,000 here. And when the customer pays, then you basically reduce the receivables with $100,000 the day that they pay. And that's how it works. And then you have other current assets. This is basically just prepayments. You prepay for a Spotify membership. You pay for a whole year, and then you only have spent, let's say Spotify for a whole year costs $100. And then you're in January, let's say 120 just to make it easier. And let's say you're in January, you've only used up January basically, so 10 of those $120, and therefore the rest 110 is basically prepayment, and it will show up here because that's what Spotify basically owes you. And as you keep on using the Spotify membership, let's say it comes to February, now you use 2 months, which is basically $20. Now the Spotify only owes you $100, and then it keeps going on like that until the whole year is finished. And by the year end, then it should be zero. Then the other current assets should be zero, because now you have used the membership for the amount that you prepaid, basically. So it's not, you're not prepaying anymore. You already used it all up. The other part is non-current assets. These are basically long-term assets. These are assets that are supposed to last longer than 1 year, and also that are not easily convertible to cash in comparison to the other one. So the first part we have here is basically PPE and property, plant, and equipment. This is called. This is basically things that you need to produce stuff. For example, for Caterpillar, this will be a building, for example, let's say a factory. Or this can be basically machines that they use to produce tools that they're gonna sell. Things that basically aren't, they're things that are meant to last for a longer time. And then you have intangibles. These are more stuff that you have that you can't really see. For example, long-term contracts. Yeah, you have some patents, for example. It can be that as well. So these are basically just stuff that you have that aren't physical. And then you have other non-current assets, which is also basically prepayments in the same way, but just prepayments for things that last more than a year. What we went through is basically assets, what that is, basically things that you own, and then there's different type of assets, which are short-term assets and then long-term assets. And then you have other groups within those again, which I explained. And this is going to be it for now. The next episode, we're going to be talking about liabilities, and also we're going to see how these two are connected together. Thank you for now.